Hello all, this is Abhilash. Welcome to the second session of the Unit 4. In this session, I am going to cover corporate restructuring, its many types and characteristics, and the advantages of the corporate restructuring. Corporate restructuring is an action taken by the corporate entity to modify its capital structure or its operations significantly. Generally, corporate restructuring happens when a corporate entity is experiencing significant problem and is in financial jeopardy. Small reduction about the corporate restructuring. The process of corporate restructuring is considered very important to eliminate all the financial crises and enhance the company's performance. The management of the concerned corporate entity facing the financial crunches hires a financial and legal expert for advisory and assistance in negotiation and the transaction deals. Usually, the concerned entity may look at debt financing, operations reductions, any portion of the company to interested investors. In addition to this, the need for corporate restructuring arises due to the change in the ownership structure of a company. Such change in the ownership structure of the company might be due to the takeover, merger, adverse economic conditions, adverse changes in business such as buyouts, bankruptcy, lack of integration between divisions, or employed personnel. We have two types for corporate restructuring. One is a financial restructuring and second one is a organizational restructuring. Financial restructuring. This type of restructuring may take place due to a several fall in the overall sales because of adverse economic conditions. Here, the corporate entity may either alter its equity pattern, debt servicing schedule, equity holdings, and cross-holding patterns. All this, all this is done due to sustain the market and the probability of the company. The second is organizational restructuring. Organizational restructuring implies a change in the organizational structure of a company, such as reducing its level of the hierarchy, redesigning the job positions, downsizing the employees, and changing the reporting relationships. This type of restructuring is done to cut down the cost and to pay off the outstanding debt to continue with the business operations in some manner. Some reasons for corporate restructuring. Corporate restructuring is implemented in the following situation. Change in the strategy. The management of the distressed entity attempts to improve its performance by eliminating certain divisions and subsidiaries which do not align with the core strategy of the company. The divisions or subsidiaries may not appear to fit strategically with the company's long-term vision. Thus, the corporate entity decides to focus on its core strategy and dispose of such assets to the potential buyers. Due to the lack of profits, the undertaking may not be enough profit making to cover the cost of capital of the company and may cause economic losses. The poor performance of the undertaking may be the result of a wrong decision taken by the management to start the division or the decline in the profitability of the undertaking due to the change in customer needs or increasing cost. Reverse synergy. This concept is contrast to the principles of synergy, where the value of a merged unit is more than the value of individual units collectively. According to reverse synergy, the value of an individual unit may be more than the merged unit. This is one of the common reasons for divesting the assets of the company. The concerned entity may decide that the divesting a division to a third party can fetch more value rather than owning it. The last reason for the capital structuring is the cash flow requirement. Disposing of an unproductive undertaking can provide a considerable cash into the company. If the concerned corporate entity is facing some complexity in obtain finance, if the concerned corporate entity is facing some complexity in obtaining finance, disposing of an asset is an approach in order to raise money and reduce debt. Characteristics of a corporate restructuring. To improve the balance sheet of a company by disposing of the unprofitable divisions from its own business, staff reduction by closing down or selling of the unprofitable portion, changes in corporate management, disposing of the unutilized assets such as brands, patents, outsourcing its operations such as technical support, payroll management to a more efficient third party. Shifting of operations such as moving of manufacturing operations to a lower cost locations, reorganizing functions such as marketing, sales, distribution, renegotiating labor contracts to reduce overhead, renegotiating labor contracts to reduce overhead, rescheduling or refinancing of debt to minimize the interest payments, conducting a public relation campaigns at large to reposition of the company its consumers. So these are the important characteristics of the corporate restructuring. So the last part is the strategies of the corporate restructuring. So there are eight types of corporate restructuring strategies. First is merger. This is the concept where two or more businesses entities are merged together either by way of absorption or amalgamation or by forming a new company. The merger of two or more businesses entities is generally done by the exchange of securities between the acquiring and the target company. The second is demerger. Under this corporate restructuring strategy, two or more companies are combined into a single company to get benefit of synergy arising out of such merger. Reverse merger. In this strategy, the unlisted public companies have the opportunity to convert into a listed public company without opting for IPO. In this strategy, the private company acquires a majority shareholding in the public company when its own name. The fourth is the de-investment. When a corporate entity sells out or liquidates an asset or subsidiary, it is known as a divestiture. So it is a de-investment. Fifth is a takeover or acquisition. Under this strategy, the acquiring company takes overall control of the target company. It is also known as the acquisition. Sixth, joint venture. Under this strategy, an entity is a formed by two or more companies to undertake financial act together. The entity created is called the joint venture. Both the parties agreed to contribute in proportion as agreed to form a new entity and also share the expenses, revenues, and control of the company. Seventh strategy of the corporate restructuring is the strategic alliance. Strategy alliance used under this strategy. Two or more entities enter into an agreement to collaborate with each other in order to achieve certain objectives while still acting as a independent organizations. And the last and eighth type of the corporate structuring strategy is the slump sale. Under this strategy, an entity transfers one or more undertaking for lump sum consideration. Under slump sale, an undertaking is sold for consideration irrespective of the individual values of the asset and or liabilities of the undertaking. So this is the corporate restructuring strategies. So restructuring is an action taken by a company to significantly modify the financial and operational aspects of a company. Usually when the business is facing financial pressures, restructuring is a type of corporate action taken that involves significantly modifying the debt, operation or structure of a company as a way of limiting financial harm or improving the business. Some key takeaways. Restructuring is when a company makes significant changes to its financial operation structure, typically while under financial losses. Companies may also restructure when prepared for sale, buyout, merger, change in overall goals, or transfer of ownership. So the company should be left with smoother, more economically sound business operations after following a restructuring. So we are done here with the corporate restructuring part. Thank you. Best wishes.